it's crazy times in the world today. So, and, these days, and that's what Fed Watch is for. So this is the perfect show for that. Of course, Dylan, who comes on almost once a month to drop just kind of macro knowledge in general. He is going to be reviewing this past month and all the craziness that we've seen. And then, of course, Ansel, who is, our historian and macro economist, is going to jump into a lot of the kind of geopolitical stuff. So we have a great agenda for all the Bitcoiners out there. Want to pass it over to Ansel. I guess, what's top of mind for you, given everything that's happening with Ukraine, global politics, weaponization of the financial system, all this kind of stuff. It's really quite astonishing.
Yeah, well, we'll get into it a little bit here today. I am already thinking what's next. So what happens after, Russia takes Kiev and this whole thing is over with? What happens to the market? I mean, right now, Bitcoin's holding up great. Stocks aren't getting crushed too badly. So, what happens next?
Well, I mean, before we get into kind of what you had on the macro agenda, let's jump over to Dylan. Dylan is our senior analyst over at Bitcoin Magazine. He runs the deep dive every single month. The deep dive drops a monthly report that kind of covers everything that happened in the previous month. So here we are. We are at the beginning of March, and I think tomorrow, Dylan, you're dropping the monthly report for the month of February.
Yes, sir. It's gonna be a good one. I think we're gonna have about like 40 slides in there and some commentary about macroeconomics, a little bit of the geopolitical stuff. That's not our forte, but it's obviously top of mind right now for markets, and how Bitcoin fits in there, and some of the metrics and what we're looking at.
Awesome. So, I mean, I know you have some slides here. You have a little bit of agenda that you want to run through in terms of covering what was in this monthly report. I guess, do we want to talk about, kind of central banks at all, or should we just jump into some of these things that you have, pointed out in terms of like Bitcoin correlations and things like that?
Yeah. I saw your guys' template. I'm happy to kind of just riff off that and follow your show and just kind of pop in when I see fit, or, my thoughts. I think a lot of it fits well together. So if you just want to run through that works for me.
And so what are you thinking here?
Awesome. Yeah, I would love to start with Bitcoin correlation. Was going through, some of the PDF, and the thing that stuck out to me was the VIX correlation, but of course that will also mean it's correlated with stocks. So can you run through what you're seeing over the last 6 months to a year, the correlation between stocks, VIX, and Bitcoin?
Yeah, 100%. So, obviously pretty strong inverse correlation between, VIX, the S&P 500 volatility index, and the price of Bitcoin. And if you just look at, say, March of 2020 as the most clear example, but you can also look at, hour by hour time frames just over the last couple months and see a pretty strong inverse relationship there. And really, I think more so what it is, it's just the liquidity tide pulling in and pulling out of this, everything bubble, and Bitcoin just being this increasingly global monetary asset, as almost, we kind of view it as like this, the poster child for central bank, escaping central bank irresponsibility. At times when there's a credit contraction, you can think of it as the dollar bidding, the denominator in the BTC USD chart or exchange, that's increasing in value. So Bitcoin, as a result, will take a hit. And I think honestly, since November, Bitcoin has been kind of the most pure form of signal in terms of central bank monetary policy. It's sniffed out what the Fed was going to do in terms of rate hikes before really equities did. And I think, it also bottomed and responded pretty hard to the Fed and really the market's expectations of the Fed walking back some of these rate hikes. And so it's pretty interesting to see that relationship. But, we saw a really strong decoupling yesterday. Like Bitcoin is up 15%. And while equities and other kind of assets just chopped around a little bit and actually were down. And so I think what we saw there is a little bit of the macro kind of sellers, the macro allocators, just ran out of ammo in terms of how much they could sell. And you had kind of the crypto natives, Bitcoin natives that have really strong conviction in this absolutely scarce asset step in and create a bottom. And so I expect some sort of correlation to remain in terms of, if equities are melting up, Bitcoin will be benefit. But if everything turns over, corporate credit continues to look pretty terrible, then I think Bitcoin faces some headwinds. But we can dig into that as well.
I wanted to jump in here. Do we want to share any of the slides regarding these correlations? It might kind of help. But again, really, really, really interesting to see this kind of decoupling. And a lot of Bitcoiners say like you don't need Bitcoin, or you need to get Bitcoin before you actually need it. And I think what's happening in Ukraine as well as in Russia and earlier in Canada are great examples of that. Is because when people are actually rushing to get their value into something that they can control, all of a sudden that Bitcoin price starts to spike up a lot.
Yeah, so I'm sharing my screen right now. This is since 2008. This is just the S&P 500 and its volatility index. So you can kind of see anytime there's a huge downturn, you see this volatility index really explode, and it's kind of reflexive in a way where everybody, it's like almost kind of like a huge margin call where everyone becomes forced sellers, and those lenders of last resort have to step in, the central banks, and kind of bail out this cascading leverage system. And so obviously Bitcoin doesn't have that counterparty risk, which is why I think that's where we kind of see this huge opportunity, is that you have this monetary bearer asset with no counterparty risk that everyone's treating recently as a risk on asset, excuse me. And I think the real asymmetry is realizing that Bitcoin is both in terms of credit contraction or credit expansion, but also increasingly about censorship risk, maybe sanction risk if you're talking about sovereign debt, as this risk off asset with no counterparty risk. And so I think we maybe start to see the market pricing that in, but obviously still a pretty long way to go.
Yeah, can you go to the VIX chart there with Bitcoin?
I have it pulled up here. Let me switch my screen over.
Maybe I'm looking at
I just posted this on my Twitter. This is the recent this is the recent chart here. So doesn't show back to 2020, but you see, the VIX absolutely blew out in March of 2020. Bitcoin actually bottomed and went down 50% overnight with this huge derivative market cascade. But yeah, every time the kind of liquidity or there's a huge sell-off in equities, and also really the driver is credit markets, Bitcoin, you see kind of it reacts like you would expect it to. And so I think that trend stays.
Yeah, I think I'm looking here at the January issue actually, but you have like an hourly VIX, and man, it timed the bottom of Bitcoin almost to the hour, which was pretty incredible. And my thought is perhaps, how much of this, I don't know. I think it's a little bit crazy that Bitcoin can track the US stock market so well, but this is happening over in Russia, and the Russian ruble is the one that's collapsing. And how do you square that Bitcoin is kind of bridging all of these markets to give us like a unified signal? And that's what money's supposed to do, right? So Bitcoin is really bridging this gap and giving a unified signal. Can you talk about that maybe?
Yeah, 100%. It was pretty interesting, like looking in February at the peak of the sell-off, and Bitcoin was 33,000. I think it briefly dipped below that. You actually saw a pretty strong reversal and bottom before equities actually. And we saw that 2 straight days. One of them was, we saw a huge reversal where I think the NASDAQ was down 4% and finished in the green. And Bitcoin, if you're looking tick for tick on the charts, like even if you want to look at the minute candlesticks on those days, Bitcoin bottomed first both days. And it's pretty crazy that it's become almost this pure signal of risk on, risk off. And obviously, Bitcoin has those risk off properties. But in terms of risk on assets, in terms of, central bank liquidity beta, Bitcoin is, I would say, as of late, the most pure signal in terms of that. And so, that VIX relationship will become increasingly important, but at the same time, the people that are trading this and selling off as the VIX explodes higher, I think are missing the forest for the trees, And that's where obviously if everything melts down completely, then there's going to be problems, and there's going to be plumbing issues, and central banks will have to probably turn on the spigots again. But interestingly enough, Ansel, I don't know if you saw, the market is actually pricing in a probability that the Fed doesn't hike at all in March anymore. And that just happened about 5-10 minutes ago. Before I checked, there's a 5% chance they don't hike at all. And so that's a pretty interesting development as volatility is exploding higher today.
Yeah, I was just reading that. An article just came out a couple minutes ago on zero hedge. And well, the number I saw was like 3%, but maybe it changed between headlines or something. That is very significant. And I mean, just like 4 weeks ago or 3 weeks ago, it was 100% chance that there was going to be a 50 basis point hike. And now it's pricing in a possibility of no hike. So what do you make of that going forward?
Yeah, so I got to give a shout out to someone on Twitter, Macroscope17. It's been basically all over this, and was calling this out in December as markets were selling off in a big way and pricing in a hawkish Fed, saying wait till markets really sell off, and if you see somewhat of a dovish pivot by Fed officials, whether they're just jawboning in the market, or maybe if you're looking at the Fed funds, the Eurodollar futures market, which is just futures market for the Fed's fund rate, you'll see, in real time that being priced in or out. And so this chart that I'm sharing right here, we have that dynamic displayed. It's not updated, but yeah, you can see, I think this is on the daily time frame, so it doesn't say 100% exactly, but it gave market a 94% chance of two rate hikes, and now that's 0% as of an hour ago. And so it's like it's almost like the Fed put in real time. And while the Fed didn't really officially change any positioning, the market knows under the surface that the Fed's not going to hike twice into a market where volatility is exploding and everything's selling off. And so that's a really interesting dynamic. And I think the Bitcoin market sniffed that out first, or maybe in the strongest sort of way.
Yeah, that's very interesting. I know stocks. I saw this maybe a week ago. Somebody was saying that stocks were rallying based off of possibly not 7 hikes, like maybe 5 hikes. So we'll see if Bitcoin and stocks rally on this. And like I want to get into with the Ukraine situation, if this is actually going to wrap up sooner than everyone thinks, I mean, we could see a rip-roaring rally both in Bitcoin and stocks. Any thoughts on that?
Yeah, I mean, I think that's definitely a legitimate possibility. Unfortunately, I mean, war is extremely tragic, but I think what the market came to realize, and what a lot of, and it's somewhat pessimistic view on the world, but it seems fairly accurate, is the people, the powers that be will do anything, or use any scapegoat to keep the music playing, and war traditionally is one of those reasons to keep everything going, keep the music going, keep the liquidity flowing, and central banks are there to kind of monetize any deficit spending that's needed. And so while the U.S. isn't officially kind of involved, and we haven't, and hopefully conflicts don't escalate, Ukraine's definitely served as the Ukraine situation has definitely served as somewhat of a headwind, and if that's out of the way, or if there's some new stimulus, some more debt monetization, increased quantitative easing, which is also a non-zero probability, then that's obviously bullish. Unfortunately, as lives would be lost in any sort of military conflict, but financial markets would respond positively in my view.
Awesome. Can we go back real quick to some more correlation? So you had on the January stuff, the GBTC spread to NAV. Are you going to update that this month? And what can you talk us through what you see as the importance of GBTC anymore versus other forms of derivatives and stuff?
Yeah, so the GBTC premium discount is still trading at, I believe, as of today, last time I looked, it's still 25% discount to net asset value. So, there's still a pretty big arbitrage opportunity there. Obviously, being kind of an OTC product, you don't have the censorship resistant aspect of it. It's not it's not nearly as liquid. You can't do a lot of things like use it as collateral in Bitcoin native derivative markets and all of that. But for institutional investors looking to gain exposure, that's obviously something that's pretty attractive to do. There is a rolling 2% fee, so we would expect naturally in its current form for there to be a discount to net asset value, but 25% is very, very strong. And I think that's honestly, in our view, took a little bit of value, or it took a little bit of allocation away from spot markets. But interestingly enough, we haven't seen that rise at all, despite Bitcoin getting bit. And so it seems to be pretty consistently 25% off of that net asset value. And I think it's one of the more interesting arbitrage opportunities against Bitcoin itself in the coming months, given that, we don't know when Gensler will approve an ETF, but Grayscale is a leading candidate just based on the size of their fund, with a little less than 650,000 Bitcoin in that trust.
One of the most incredible things that I have seen from kind of like this debacle of the GBTC premium flipping to a very, very steep discount is like the marketing that is kind of emerging from it, where Grayscale is like prompting investors to like lobby the SEC to behave differently. It's really kind of incredible to see it all play out in real time. And I'm just speculating, but I think a lot of funds, a lot of traditional managers got caught on the wrong end of that trade and trend at the beginning of 2021. And they're still hurting. They're still hurting bad. So I don't know, just some observations there. And I mean, I don't see anything saving any of those investors until an ETF happens.
Yeah, that's a great point. There's definitely a lot of people that got caught off sides. Interestingly enough, looking at the chart right now, shares of GBTC are just slightly, actually, no, they're not. I'm looking at the daily view. Despite Bitcoin being at $44,000, shares of GBTC are actually below their peak in 2017. So obviously a product that doesn't track directly to net asset value, and an asset that increasingly lots of people and institutions want to allocate to is not optimal. So, you could have done everything right, nailed the Bitcoin trade, but it, due to its tracking errors and, given that it's not an ETF structure, you could have underperformed. A lot of people got caught on the wrong side of the arbitrage trade that was seemingly risk-free. And so that unwind, I think, helped exacerbate the sell-off. But I think for the most part, that's kind of behind us in terms of, having a huge market impact.
Do we want to talk about on-chain? Obviously, there's a lot of factors here, and there's always kind of that dichotomy with how things are looking on-chain versus how price action is actually playing out. I mean, in terms of what you're seeing from the on-chain analytics, Dylan, what's jumping out at you?
Yeah, so I can reshare my screen here. Basically, keeping it pretty simple, a couple of things we look at. One of them, this is just pretty simple. It's Bitcoin, the percent of circulating supply that's moved in the last 3 months. And basically, it's not at historic lows. It was actually, we reached at in October, right as we were hitting all-time highs. But this is just, basically keep it simple. It's, the free float of Bitcoin on the market that's being traded around, that's available to buy at, it just that has moved on chain is at historic lows. And so we've, the story since really November has been on chain is the supply side dynamics are extremely strong, but we haven't had that demand. We've actually seen marginal selling and reducing exposure and position size from sort of the macro crowd who's trading based on what they think the Fed and that kind of liquidity wave is going to do. So that's been marginal selling, and our kind of thesis and our base case has been when this marginal selling turns into marginal buying, which we've seen in recent weeks. And I still think that we haven't even seen strong marginal buying due to the risk off that's still occurring in legacy markets with volatility and everything that we just talked about. Bitcoin's really primed to explode, given just how tight these supply side conditions are. And that's kind of the beauty of on-chain. So it doesn't say when it's going to happen. And we honestly can't know. That's why we kind of take a multipolar approach to evaluating these things, macro, Bitcoin derivatives, and the on-chain side of things. But in terms of supply side dynamics, 85% haven't moved in 3 months. I believe it's 61%, almost at all-time highs, haven't moved in over a year. So, it looks great from that on-chain side, the supply side. It's almost never looked better.
Now, can you combine the last two the last two topics, the GBTC discount and the lack of buying by GBTC, and maybe this on-chain stuff? So perhaps since GBTC is not buying spot Bitcoin anymore, that translates into long-term holders. What do you think about that idea?
Yeah, that's interesting. I honestly I'm not familiar or entirely sure, GBTC's huge stash and whether that's moved at all, or the nuances of that data. Cause I mean, it's definitely a large role given just, how much of the circulating supply they actually hold. I do know that they're just kind of auto selling 2% divided by 365 basically every day. So off the top of my head, and this may be way wrong, I believe they're selling around 35 Bitcoin a day in terms of their exposure, just due to the auto roll off of their fee structure. But yeah, I mean, they were one of the biggest buyers and drivers of the bull market. But that Bitcoin not moving on chain, or it may be, but I believe it's not moving on chain, definitely doesn't hurt these kind of supply side dynamic structures.
So following on from that, then would you consider GBTC and GBTC holders like the secondary market? I don't know, how would we rank them as long-term holders versus short-term holders? Because that's one of the metrics that you guys look at a lot on your report, and it seems to be extremely accurate. I'm very interested in the next, say, 4 or 5 years, the derivatives and how that affects some of these on-chain metrics. Can you speak to that maybe?
Yeah, that's a great point. So the long-term and short-term holders, what that does in its Glassnode, basically doing some pretty advanced heuristics with the data, but they factor out exchange balances. And I don't believe they factor out Grayscale Bitcoin. I would love if someone corrected me there, and if they did, it would give me some clarity, but I'm not entirely sure. But it definitely has a pretty large market impact. I think it becomes resolved, hopefully, after, well, I guess if they turn into an ETF, where the kind of the inflows or outflows would be based on market demand, and you'd actually see those UTXOs moving on chain, being transferred around. But I think for the most part, they're just kind of sitting in cold storage with Barry, just selling a clip every single day. So I would imagine those are being factored in as long-term holders, given a long-term holder waits into that cohort at around 155 days or so about 5 months. And so, we can see some pretty interesting stuff with the dynamics between short-term and long-term holders. But yeah, I think Grayscale, for the most part, a lot of that GBTC would be factored in as long-term holders.
All right, thanks. Christian, you want to take us into the stablecoin question?
Yeah, no, absolutely. So, I mean, I think we have two of the most insightful people to talk about stablecoins. Obviously Dylan kind of talking about how it plays into Bitcoin price action in the market, and then Ansel just understanding the macro political implications of stablecoins. So, I mean, Dylan, let's talk about what you have to say about it. Especially given the report in February, and then maybe Ansel can add some color.
Yeah, so gonna share my screen here again. Added a chart, and forgive me, it's not properly labeled just yet. We're gonna get it in deep dive format, but a couple interesting things of note here. So here I have a chart with 2 lines. The first line is just aggregate stablecoin balance on exchanges. So right now it's a little less than 30 billion. The stablecoin market's seen explosive growth since really 2018, but especially after 2020. There's just a huge demand to kind of get seamless dollar rails in crypto markets. A large amount of this has to do with Bitcoin, but increasingly the emergence of DeFi ecosystem, collateralized lending, these sort of protocols. There's really a demand for dollar yield, a dollar denomination, and so stablecoins fill that role. We have USDC, we have Tether. But one of the most interesting dynamics, I think, is taking a look at just the stablecoins on exchanges. And then this red line here is taking the total Bitcoin on exchanges and just taking a ratio of the two. So we have about 30% of the aggregate stablecoin supply on exchanges. It's about 30% of the Bitcoin on exchanges, and that's really hockey sticking up as of late. And so you can think of that as like kind of the dry powder available to buy on the sidelines, just on exchanges. We're not talking about aggregate supply. Continues to increase here as stablecoins on exchanges increase, and as the Bitcoin market saw some some headwinds over the past 4 months or so. And so that's one of the things that I kind of believe is quite bullish, and it shows me there's a lot of dry powder still on the sidelines.
Yeah, go for it.
Sorry, I was just going to say the point that I thought was very interesting on the January report was that this will decrease the volatility of Bitcoin price, because no longer are people, margining, going leverage long on their Bitcoin. They're using Tether. So can you walk us through how use of Tether actually has some sort of synergistic effect that makes Bitcoin less volatile?
Yeah, so 100%. For the most part, when Bitcoin derivatives, crypto derivatives really started to grow in popularity, all that was available was native crypto margin. So if you could trade, and you still can trade Bitcoin derivatives, ETH derivatives, at any sort of kind of crypto leverage exposure, but it was for the longest time you could only do that with the native asset itself, or with Bitcoin or maybe Ethereum. And so there's a really, there's an inverse relationship there. It's like kind of a convex relationship where if price draws down and you're long, your collateral also decreases in value, and it kind of creates these really like kind of black swan events where everyone becomes a forced seller on the long side of the derivative order book, and everyone gets wiped out. And so stablecoins, as they've grown from, in terms of open interest on the derivative market, it was about 70%. At the top of the market in April of 2021, 70% of the open interest was crypto margin. So you had traders just longing their longs, and they were doing it with Bitcoin. And so as a lot of those traders got liquidated, and the forced selling and all that leverage kind of unwound, what we saw what kind of emerged as a result was far more stablecoin collateralized derivatives. And so there's not that inverse relationship there. Your liquidation price doesn't move up as price is going down when you have stablecoin as collateral. But if you have Bitcoin as collateral, if you've ever been long and you've ever traded Bitcoin derivatives, you'll come to find out that as the price draws down, your liquidation price moves up as your collateral declines in value as well. And so I think that takes a lot of new traders by surprise. But yeah, the overall relationship, I think now about 40% of that open interest in this Bitcoin derivatives market is maybe a little bit less, is crypto margin, down from 70%. So stablecoin OI, much healthier, and leads to far less kind of these huge, liquidation events that have Bitcoin become kind of notorious of over the years. And so that's healthy from our view.
Just to jump into that as well, and to take a step back to your earlier point, it's important to kind of understand that when there are stable coins, quote unquote, on exchange, like that's people who are not holding Bitcoin, but they don't intend to go into the fiat system. So that means they're eventually going to go back into Bitcoin. So it really is like dry powder. And it's really incredible to see that when dollars turn into tethers or dollars turn into other stable coins, they very rarely cash out. And same with Bitcoin. Like as money flows into the system, it really stays in the system. And Tether and USDC on exchanges is a really interesting way to kind of just see how that value ebbs and flows, but doesn't actually leave the crypto space.
Yeah, 100%. I think another interesting point, and shout out to Lynn Alden for really highlighting this and banging the drum on this, is that the thing that I don't think gets as much coverage, and maybe not so much with Tether or these kind of offshore stablecoins, if you want to think of them like that, but the growth of the stablecoin ecosystem in general is actually creates kind of newfound demand for U.S. debt. And so that's the kind of from the regulatory side. From the traditional lens, there's a new buyer of U.S. debt that whether it's short dated treasuries, long dated treasuries, they buy treasuries and basically, kind of issue an IOU on a blockchain, something like a USDC. That's what Circle does. And so there's a tiny yield that they get, but you get this kind of bearer asset that obviously can be censored. It's not immutable like something like Bitcoin, but there is this kind of new dollarization of crypto markets. It's actually outpaced the growth of Bitcoin markets and crypto in general over the last couple of years. And so that's a very encouraging trend. And honestly, it's really healthy.
That's very interesting. So when we talk about like how much US debt China holds or how much Japan holds, or, these different central banks in different countries, how many foreign currency reserves they have, we should really add like US dollar stablecoins to that. Imagine when Tether or combined US dollar stablecoins surpasses $1 trillion in, US government debt. That is going to be a very big day. And I can see it coming very shortly. I wanted to expand this and just ask, I think I know the answer, but is anyone using Euro Tether?
It is a thing. I believe there are Euro stablecoins. I believe there are some yuan stablecoins, but in terms of the crypto market, that's just, it's very, very minuscule. But I think it's out there. I just don't think it's at all popular, even on offshore exchanges. Everyone wants dollars.
So yeah, this is something that we've been talking about on the show a lot, is the fact that one, we have a bearish CBDC perspective, and it's mostly because we view USD stable coins as being like innovation on top of the dollar. It's like the dollar evolving. And there's a reason why all these central banks are scrambling to go digital and the US doesn't care. It's because the USD dollar has already innovated to the crypto space and has massive market dominance, via these private issuers, whereas the euro has nothing, the yuan has nothing, and they're trying to quickly make sure that Tether doesn't wreck the own viability of their currency on their own home soil, let alone even expand internationally.
Yeah, that's a great point. I think the most interesting thing, aside from just Bitcoin's pure monetization process, and kind of the emergent monetary standard that we're living through, is what happens to the cost of capital as, like Ansel said, we see stable coins. I think honestly, there's a chance, I'm not sure the total market cap right now. I believe it's somewhere around 150 billion. There's also we haven't even talked about like algorithmic stable coins, which are a little bit different, and kind of its own interesting rabbit hole in their own right. But when the stablecoin market surpasses, say, $1 trillion or grows even larger, and you kind of have this free market for the cost of capital, whether that's in Bitcoin futures, where you have this risk-free kind of arbitrage between the futures price and the spot price, or whether it's DeFi protocols, or whether it's just inter-exchange dollar lending with, say, like on FTX, you can lend your dollars to margin users, right? So like there's all this stuff that's outside of the purview of the Fed and the Fed funds rate, which is US dollar denominated cost of capital. And so that's kind of one of the things that I find most fascinating to watch over the coming couple months, coming couple years, is what that looks like, and what's kind of this emergent free market cost of capital look like.
Something I just thought about, can Tether be sanctioned like, we've seen with Bitcoin third-party accounts and stuff like that? Can they censor Tether as well?
I do know Tether, in terms of, say, sometimes there's hacks and all that. Tether itself can freeze wallet addresses and all that. But in terms of Tether's reserves being sanctioned or shut off or frozen, I'm honestly not sure. And actually, I don't have too much of a strong view there. And actually, somewhat myself, I'm short Tether. I have borrowed Tether to actively currently and purchase some Bitcoin using some collateral. And so, I'm not necessarily bearish on Tether, but I'm certainly not bullish on it appreciating more than $1. And if there is any downside risk, then I won't be hurt. I'll actually benefit.
Yeah, I mean, I think it's the Tether situation is extremely interesting. And, we already saw the calls from the Ukrainian government to censor Russian users on crypto exchanges and things like Namecheap censoring Russian users or Russian IPs and asking customers to take all of their IPs and migrate elsewhere. We're really seeing like the politicalization and the weaponization of internet infrastructure, payment infrastructure, et cetera, et cetera. And it's honestly unbelievable. And we already know that Tether will freeze exchange hacked coins and things like that. If you're hacking an exchange, don't steal the Tether because it's going to be worthless. It's going to be frozen. Same with USDC. So if they will comply with exchanges, there's a threshold in which they will comply with governments. And I have no doubt that, if a major G7 government really started barking up the Tether tree in terms of freezing funds in order to not get their bank accounts sanctioned, they would do it. I have no doubt about that.
Yeah, I just thought it was interesting because if we go into a dollar shortage type situation and these other countries are going to be selling their US treasuries to get access to dollars, and so their amount of treasuries goes down, but they might want Tether, and then Tether has to buy more of the US treasuries. So like they can easily swap. I'm thinking of like a future where the demand is reversed and they easily swap, and Tether becomes like a geopolitical juggernaut all on its own. That'd be crazy.
Yeah, I think that there'll be kind of a bifurcation of, regulated stablecoins, USDC, Gemini, like kind of maybe exchange stablecoins, maybe there's commercial banks enter the arena. We'll see. And I think there will be, similar to kind of how there's the euro dollar market today, there'll be offshore crypto dollars, whether that's Tether, whether that's, we're seeing really kind of interesting experiments with algorithmic kind of collateralized stablecoins, all this stuff. It's the wild, wild west, but, it's going to be interesting to see it all play out. And, it's definitely kind of this like kind of emergent, like dollarization of crypto markets besides what we focus on, which is obviously Bitcoin.
So let's jump into some more macro news topics. Ansel can kind of lead the agenda here, and then we can get Dylan and my commentary.
All right. Well, I just wanted to give an update on the Russian banks and the ECB situation. So the ECB has sanctioned Sberbank, which is the largest bank in Russia, but their European arm. So that's a pretty big move for freezing assets by the ECB. Other news from the Russian central banks is, of course, some banks will now be sanctioned or banned from SWIFT. We don't know exactly which banks or for which type of transactions they will be banned, but there's a lot of different ways that they can work around this. A lot of people are saying that Russia and Iran and China, they have these plans to circumvent SWIFT with their own system, their own messaging system, but they can still use SWIFT in different ways. So if take two Russian central banks, one of them, or two Russian banks, one of them is sanctioned and the other is not, the sanctioned one can just run the transactions through the unsanctioned bank. And that wouldn't be really that hard at all. The US could, or authorities, quote unquote, financial authorities could crack down on that pretty easily, but will they? Because, they're already kind of tiptoeing around sanctions. We're not going to sanction the entire country. We're not going to sanction oil exports, things like that. So would they clamp down on nesting transactions by unsanctioned banks? And then the other one, the other news I saw that was related to this, the Chinese were actually fairly surprised by all of these events. And a Chinese spokesman, I don't know if it was for the PBOC or just high level up in some bank there, they said that the alternatives don't make any sense because they still run through banks and those banks will be sanctioned. So the alternatives that people claim China and Iran are setting up won't work. So as a Bitcoin show, of course, that makes us think, well, Bitcoin is the only alternative. So do you guys have any comments on that?
Yeah, for sure. I've read some interesting stuff about I honestly had to study up to write this monthly report. I put a tweet out jokingly last week, and it was like, here's a thread on my thoughts on the Ukraine situation. And then the second tweet was, I don't have an informed opinion, end of thread. And so in the recent week, I've done a ton of digging and try to inform myself of what's happening. And I think, there's a couple interesting implications. One, obviously, Putin has a lot of leverage with how dependent Europe is on natural gas and kind of Russian commodities in general, really the whole world, not only for energy, but also kind of with food chains and how much they rely on natural gas for stuff like fertilizers. And so he has a lot of leverage. And I think that's why the West, the US, Europe, NATO countries are saying, all right, we're sanctioning Putin, and they're making a big show out of it, but it's really kind of a slap on the wrist. And so, we'll see if that escalates, how that plays out. I think no one knows what Putin's thinking except Putin himself. But yeah, I mean, he definitely has a lot of leverage. And if, there is some real crackdown on actual sanctions with the SWIFT network, then I saw a really interesting point by this guy, Zoltan, I forget his last name, saying that settlement networks are like supply chains and are like the opposite of supply chains. Like payments, they're like in reverse of supply chains. And so we could see some really interesting kind of counterparty risk emerge if there truly was a real crackdown on the SWIFT network with something like Russia. And so I think, the markets started to price that in a little bit. Futures opened up super bloody this past Sunday, obviously reversed. But I think, everybody's trying to sort out who has counterparty risk and where, and, what are the kind of knockoff effects of credit markets, if any at all, depending on the situation.
Yeah, I tweeted this weekend that I'm really confused. The only thing that I can, think of for sure that, will happen with this is just loss of trust. We've seen this in Canada, and now with what's happening now is loss of dependability of these systems, loss of neutrality of these systems. We're even seeing Switzerland be a part of this, which is very unlike what they've been historically, even in World War II. And, us as Bitcoiners saying that Bitcoin is the only alternative. Well, Bitcoin's the only Switzerland here now. Bitcoin is Switzerland. That's the only place that, behaves this way. And there's always been a time in history where that's needed, at any point in history that's been needed. So I think it's pretty huge here. I mean, again, the crumbling of trust in the fiat system and the gaining of trust in Lindy and Bitcoin, I think that's the general trend that we're kind of seeing unfold.
I mean, it's been pretty crazy the last month or two, right? I mean, we saw what happened in Canada, and then we saw Ukraine, a sovereign nation getting invaded, posting not only Bitcoin, I mean, they posted crypto addresses, but posting crypto addresses over Twitter saying, hey, donate to us. And then, we saw Russia basically, never mind the fact that they've been stockpiling gold and de-dollarizing for the last half decade plus, kind of go off the rocker in a geopolitical sense. I think most people don't really realize like we're maybe at the start of a bifurcation of this like unilateral monetary order we've been in for the last 5 decades, whether that's, Russia and gold, and nominally their currency is the ruble, but it's really gold and oil. It's their raw commodities. That's what Putin's doing. But whether they team up with China, like what we're seeing is really kind of this order, this petrodollar order that's emerged since 1971, but really Bretton Woods start to fracture. And countries like El Salvador are saying, hey, we want Bitcoin. Individuals are saying, hey, we want Bitcoin, or maybe we'll monetize equities. But I think, with sovereign debt and real yields deeply negative, there's no longer kind of that attractiveness of holding it. And especially with, sanction risk, credit risk, right? So that's kind of what I think that the big picture is here.
Yeah, you bring up gold, and that's a very important point because, Russia, well, they have a lot of Bitcoin too, but they have a lot of gold. And Okay, so they had 100, I think it's 150 or 160 billion dollars worth of assets outside of Russia in the banking system, and so those are all frozen. And if they need liquidity, they're going to have to sell something, right? So they officially own a lot of gold reserves, and so I think that this could translate and be very bearish for gold actually if Russia has to start unloading that to liquidate some of their assets. And that won't affect Bitcoin because the government doesn't officially hold that Bitcoin to liquidate it. So I think this is kind of an interesting game theory on gold versus Bitcoin. Do you guys have any thoughts on that?
I want to hear more of your thoughts, but yeah, I guess Dylan, jump in.
Yeah, I mean, I think, does Russia actually hold Bitcoin? Is that known or no?
Not officially.
Is that yeah, speculation?
Rumors is that they have a lot. Rumors that they have a lot of crypto.
Well, there was a report that said the Russian people own like 60 billion worth of crypto. So, but not the government, just the people.
I was getting a lot of heat on Twitter. Last week I posted when kind of this was going down. I was like, the third largest energy producer in the world is in need of a new monetary settlement network. And people like got all mad at me for saying that and I was like, I responded with, Bitcoin isn't good or bad. It just is. And if you want to use Bitcoin, then I can't do anything to stop it. You can't do anything to stop it. They're going to use Bitcoin. And so, it's the network itself. And so naturally, I think that's where it'll all gravitate to. But, gold as a reserve asset relative to sovereign debt. I mean, that's interesting. There's a production cost there. It can't be printed away. And so I think, Bitcoin's obviously that solution in the end, I believe, a lot of that we believe. But gold is kind of this monetary bearer asset of the past. And so that's the role it's traditionally served for the last, millennia.
Yeah, I want to go back to you, Ansel. What do you think? I really am too dumb to really have anything informed to say here.
No, that's about all my thoughts is that it's going to be bearish for gold and not bearish for Bitcoin. And the result of that will be, Bitcoin is seen more as a go-to substitute than gold. Gold is slowly being demonetized while Bitcoin is slowly being monetized. And so, yeah, I think this situation could point out some strengths for Bitcoin and some weaknesses for gold. Gold is captured, right? Bitcoin is not captured quite yet. I mean, eventually it probably will get more captured than it is today. Hopefully not like gold because it's not physical and it can't be seized as easily as gold can. So I think this definitely highlights a difference between gold and Bitcoin.
Yeah, if I could just jump in, my one smart thing to say is that, gold is not slowly being demonetized. Gold has already massively been demonetized. And that's why we've seen the massive financialization and use of other things as store of value. And really what's happening with Bitcoin is kind of just arbing that massive gap while still pushing up against gold too. So it's really eating at two things, which is the store of value market that's bled out of gold previously, as well as into gold's, whatever's left of gold's monetary status. I want to get into China. I know we're at the last 15 minutes here. I guess Ansel, ruble, China, why don't you lead it here?
All right. Well, we covered the ruble. Let's get into the Chinese news. So like I said a few minutes ago, they seem to be generally surprised by the Russian activity. They didn't have an official comment for almost a whole week. And now just recently in the last 24 to 48 hours, they have, some official stories on the official Chinese news networks are starting to dribble out where they support country sovereignty above all. And it's kind of a jumbled message because, they're not supporting Ukraine's national sovereignty. They're supporting Russia's national sovereignty over Donbass and all those other regions. So it's kind of a convoluted message. It seemed to catch China off guard. And so I don't think there is as close coordination as people think. So this is also in line with my news on SWIFT and how the alternatives to SWIFT still must go through the banks. So they're still sanctionable. Um, my main point is here that these guys aren't working together as closely as others think to take down the dollar. And so when we talk about a dollar going forward, dollar versus Bitcoin, dollar versus gold, whatever the case is, there's not some large collusion on the other side to take down the dollar. I still think that, you can't just choose not to use the global reserve currency. If you're kicked off the global reserve currency, you're going to suffer. And the second best thing is a long second best. So any thoughts on that, guys, or should I go into some more of the kind of consequences?
Yeah, I guess I would just add one thing is that I kind of agree with you there. If China doesn't want to, if China wants to stop holding dollars, well, they would have to kind of stop producing an economic surplus and selling goods to the U.S. And then, what do they do with those dollars after? And traditionally, it's kind of been just recycling back in the treasury market. But obviously, that's somewhat eroding, right? The Fed's becoming a larger buyer in terms of as a percent of net issuance than ever before. So the trend's moving the other way, but there's still the dollar is the world reserve currency for the time being, and I don't think that changes overnight at all.
All right, well, let's go into another topic that a lot of people are talking about. That this Ukrainian situation gives China an excuse or cover to maybe retake Taiwan. And I just wanted to point out a few things contrary to that narrative. This year is the 20th Party Congress in China. And so they very much, by October, they very much want peace and prosperity. They don't want anything rocking the boat right before they have a major conference with the CCP. So it's unlikely that they would start some major sort of invasion of Taiwan right before that. Also, they've been really watching the sanctions on Russia closely. Russia is much less intertwined with the international trade network and the international financial system than China. I mean, China is obviously the second largest economy, but they also, import. They're the biggest importer and the biggest exporter in the world. And so they're watching these financial sanctions very, very closely. And I think they're actually concerned by that. They don't want to bring those financial sanctions to China. So in these UN votes that we've seen, where India and China abstained, they didn't vote no, right? They just abstained. If they don't want to be seen as taking sides, they're kind of playing a neutral role. And I just want to lay that out for people. So, and any thoughts on that, Dylan or CK?
Yeah, I would say you know the situation far better than I do, and I don't think I can add too much value there. You said it pretty well.
Yeah, right. I mean, I just think it's going to be interesting to see how it plays out. Obviously, like Taiwan, South Korea, I think we were talking about it earlier on the previous segment, but those are very, very critical, digital infrastructure areas for the West. And they are both a hop and a skip away from China. And South Korea is literally right there, and Taiwan is literally right there. So that's going to be one of the most interesting storylines to watch, period. I think your observations around the 20th Congress, obviously numbers are very important to Chinese culture. And there's a lot of, kind of historical context into a lot of things that they do, as well as, kind of working with the CCP. But, obviously China is always trying to gain geopolitical ground. We saw what happened with Hong Kong, and there's no reason why that can't happen again, and why the West might even tolerate it, because they have even more leverage than Russia. Because, what's going to happen to the West when we say, okay, hey, sorry, China, we're going to sanction you on everything, but please keep sending us iPhones. I don't know if it's going to work out that way.
Well, the US doesn't necessarily, or the world doesn't necessarily need a new iPhone as much as they need that next liter of natural gas. So I think that Russia actually has more of a card to play in that regard. China is a net importer. They import 70% of their energy. So I think it actually makes China more vulnerable to these type of sanctions, where Russia is kind of negotiating from a position of strength.
At least from a more primitive perspective, like, heating and energy. That's what you're saying.
Yes. Yep. That's all I got for updates on global financial conditions and central bank stuff. So what should we do now? Where do you want to go?
Do we want to hit on these last Fed topics? I know we got less than 10 minutes left.
All right. Well, I just have the same thing that Dylan brought up earlier about that the rate hikes are looking less and less likely. It went from between 7 and 9 rate hikes back in late January to now only 4 or 5 rate hikes. And it's the fastest decline in this certain reading that I saw a chart of in 12 years. So it's a very, very significant drop in the likelihood of the Fed raising rates. Dylan, do you have anything to add to our earlier conversation about Fed rate hikes? Maybe what do you see for GDP going forward, and how will that affect like investors in Bitcoin? Maybe you could tie that together.
Before you jump in, I just want to say that we've been saying this on Fed Watch the entire time. We've been skeptical on rate hikes. We've been talking about the job owning. So we've been talking about this the entire time. Dylan's been a part of many of those conversations as well. But back to you, Dylan.
Yeah, you guys have been all over it. I guess just the things that I'm watching is in terms of kind of credit markets is obviously these Fed rate hikes, these futures markets, Eurodollar futures, what the treasury curve is doing. We saw the short end of the curve is really sold off in a big way over the last quarter, 3-4 months. And really more so is what are corporate credit markets looking like? The sell-off in equities has been partially kind of due to these rising rates, but I think it's more so about the multiples than about the financing costs, right? Where higher yields on kind of these risk-free rates of the treasury market means that the earnings multiples, or if you want to think of it as like almost an earnings yield, the inverse of the PE ratio is like an equity yield, an earnings yield. And so as that discount rate has risen, that earnings multiple, kind of what you price every equity off of, the valuation based on its current earnings, has contracted. And so that's the reason for the sell-off. If things worsen in terms of, if you look at like corporate credit spreads, which is what's the financing cost for investment grade corporates, for high yield corporates above the risk-free treasury rate, that has some pretty big implications for financing costs in a corporate environment that's never been more indebted. So I think we haven't even seen that yet. And it'll be really, really interesting to watch for how these corporate credit markets go moving forward, because I mean, I think junk bonds are still below the nominal inflation rate. So return-free risk before any default risk is taken into account. Obviously, pretty big catalyst if those debt markets really go cataclysmic and sell off, and it'll put the Fed in a really tough place. So that's kind of where I expect a lot of this capital is gonna flood into a neutral apolitical reserve asset. But yeah, I mean, I think that's kind of what has me a little cautious for the kind of broader economy going forward is what's happening in these credit markets, specifically the corporates.
So, I mean, I think we wanted to close with just talking about a really zoomed out perspective, which is just the psyops, the misinformation, a lot of the things that are happening around us. And, you could even summarize it as calling it meme warfare. But this idea of meme warfare and those who control the information and the narrative have the power. I feel like it's never been more real than it is today, especially given the virality of the internet and the indiscretion of those viewing information on the internet. Dylan, maybe do you want to jump on your ideas there, and then maybe Ansel can jump in too?
Yeah, I mean, propaganda is a lot harder than it is today. Misinformation. Well, I guess misinformation goes both ways, but in terms of the official narrative that a certain group of people in power may want you to think or not, with the internet, we kind of have this signal that's flowing, across airwaves 24/7, 365. And so, if you want to find truth, you can. And I think, that those effects are not very well understood by a lot of people in power, or maybe in the incumbent kind of legacy media. The internet's pretty powerful in that regard. So bullish on information asymmetry kind of diminishing.
Yeah, and I'd like to add that we don't have to tell our audience this, but don't believe what the mainstream media is selling you. Immediately on this incursion into Ukraine, there was all of these false stories that even the president of Ukraine, he confirmed. Like I think it was Stone Island or whatever the name, Bear Island. I don't know what the name of that island was, where like 13 Ukrainian soldiers were supposedly killed. Turns out that it was completely false, even though Zelensky had confirmed it in like official correspondence. And the ghost of Kiev, the airplane that was shooting down all these Russian jets and stuff, who knows what the fallout is. But right now it seems to be that this whole thing is really being run off of memes. Another example is today, Lavrov, he is one of the diplomats for Russia. He was speaking virtually to the UN in New York, and 100 diplomats got up and walked out. Now, you do that kind of thing for the photo op. You do that kind of thing for the meme, the narrative. There's no reason to do that if, they knew what he was going to say. It was just a photo op. So, just be careful what you believe. I'm watching for what's coming next, because I really think that this whole Ukrainian thing is going to be ended pretty soon. And what is next? And I think that is this recession, like we talked about with the Fed not being able to raise rates. The ECB has now even come out and said they might not raise rates until 2023. They keep pushing that back. So I think the narrative is going to switch very quickly to stagflation, and Russia will be a rearview mirror.
Probably a scapegoat.
And a scapegoat, yes.
We have stagflation because of the war in Ukraine and because of the further interruptions of global supply chains. All right, y'all, we're getting to the end of time. This was a great show. We hit on a lot of topics. I want to thank Dylan for taking a break from his extremely busy day working on his monthly report for the Deep Dive members. Thanks so much for coming on. Dylan, where can people find you, and where can people learn more about the Deep Dive?
Yeah, thanks for having me on. A lot of fun as always. Good catching up with you guys, and you've been on the money for the past couple of months here since I've been hopping on. So I think there's a lot of signal here. You can just find me on Twitter at Dylan LeClair _ do the deep dive like CK mentioned. I've been working on the monthly report recently. We're going to send that out to paid subscribers tomorrow. And then we're going to release it to everybody on the free tier, which we have as well next Monday, I believe. So make sure to subscribe. If nothing else, give the free tier a try. I don't doubt that you will find it of value. So appreciate you having me on.
All right. Awesome. Thanks again. Give Dylan a follow. He is one of the purest signal people on Bitcoin Twitter. Give Ansel Lindner a follow. He has been dropping signal for a long, long time. One of the people that actually orange pilled me. And give me a follow at CK _ snarks. Go enjoy the